Financial independence isn't just a dream, it's a goal you can achieve with the right plan. And today I'm sitting down with JL Collins, author of The Simple Path to Wealth, to share the exact steps you need for that simple path to build lasting wealth and what he calls FU money. This isn't about chasing get-rich-quick schemes. It's about mastering a simple, proven strategy that puts you in control of your future.
The most important thing my money could ever buy for me is freedom. Freedom to spend my time the way I want to spend it. Freedom to step away from any job I choose, freedom to live my life on my terms, and it's possible for anyone.
I'm Chris Hutchins, and if you enjoy this video, give us a thumbs up, or if you have a question, leave it in the comments. And if you want to keep upgrading your life, money, and travel, consider subscribing. JL, lots of people throw around the term FU money, yourself included. How do you define it, and why do you think it is so important to financial freedom?
Yeah, so I think I define it a little differently than most. I think in the most common vernacular, FU money is the same as being financially independent, which is to say you have enough money that you no longer have to trade your labor for money in order to pay your bills and live your life. Just for me personally, the way I define it and the way I use it is financial independence is when you get to that fully independent stage, and FU money are the steps along the way. So in a sense, the moment you begin saving and investing, you now have FU money. It's kind of like going to the gym. The moment you go, you're not going to be bench pressing 300 pounds the next day, but you're a little bit stronger than you were the day before. In my own life, I've found that having surprisingly little FU money allowed me to be bolder in the choices I was making. And that's kind of the point. And of course, the more FU money you have, the bolder you can be. And it reflects the fact that I see this as a journey. So a lot of people are intimidated when they start because they say, wow, being financially independent at some large amount of invested assets, that feels like a long way off and maybe not even possible. It's not an on-off switch. You don't have to wait for the benefits to come to you until you're at that destination. The moment you start, you become stronger. And that's one of the reasons that sometimes I'll get questions from people who are at an advanced stage and they say, there's no hope for me. I don't have the time to become financially independent. Well, that may or may not be true, but in a sense, it doesn't matter, because you can make yourself fiscally stronger. And that's having FU money.
And do you have some examples for people who, in their mind, FU money is kind of equally unattainable or far away, but how it might impact their life with a smaller amount of savings?
The easiest thing for me is to give you an example from my own life. And I knew from an early age that I didn't always want to be dependent on my ability to earn. So when I came out of college, which was in the 70s, a very tough economic time, it took me 2 years to get my first professional job, which paid the princely sum of $10,000 a year. And I knew that there were people living on $5,000 a year. So there's no reason I couldn't do that. And I kind of arbitrarily said, I'm going to save and invest half of my income, $5,000. And I'll live on the other $5,000, which, by the way, never felt like deprivation because it was a whole lot more than I'd been living on in college. And so you fast forward a little bit, and I want to say about a little better than 2 years, and I've now saved the princely sum of $5,000. And I got it into my head that I wanted to go to Europe for a year and backpack around. But I liked this job, and it was not easy to get. And I went back and forth in this in my mind for a long time. And finally I thought, well, if I could go for a few months, maybe that would scratch the itch. And so I went to my boss and I said, how about I take a sabbatical and go away for 4 months? I'd found an airfare. It was cheap. And that, of course, appealed to me. And so I broached that with Carl, my boss, and he said, well, no. And at that point in my life, I didn't really understand these things were negotiable, right? I thought, your boss says no, your boss says no. So now I'm back to my original dilemma. Do I give up this job that I like and that was hard to come by and go to Europe, or do I give up the dream of going to Europe. So I wrestled with that for a week or so, and I decided, I'm going to go to Europe. And so I went back to Carl and I resigned. And this was not a negotiating ploy, by the way. And to my amazement, he said, well, why are you resigning? And I said, well, I want to do this thing in Europe, and I'm going to go for a year. And he said, whoa, hang on. He said, don't do anything rash. Let me go talk to the owner of the company. It was a small company. And a couple of days later, he called me back in his office. He said, well, if you can guarantee us that you'll be back on that day you mentioned, then we will hold your job open for you. Well, that's the power of FU money. And that only took $5,000, that I had enough money that I was willing to make a bold choice.
So in a way, FU money lets you say yes or no to certain financial situations, but it doesn't mean you can't work ever again. Whereas, your true financial independence, I would guess you would define your FI number as you do not need to work. Is that right?
Exactly. It pays for all of your expenses and perhaps a little more, a little bit of a cushion. That's my idea of being fully FI. And of course, there are mathematical formulas for that.
Yeah. A couple weeks ago, I had Karsten from Early Retirement Now on, and we spent an entire episode on the safe withdrawal rate. But we didn't spend a lot of time on the path to get there. And you wrote the book, right? The Simple Path to Wealth. What is that simple path?
So the simple path to wealth is avoid debt or dig yourself out if you have it, live on less than you earn, and invest the difference. And if you do those three things, you will wind up wealthy, and not just in money. You'll wind up wealthy in your life. It's a better way to construct how you live.
It seems ridiculous to say this, but it sounds so simple, right? Like it's just these three little things, yet so many people aren't able to do this. What's getting in the way?
Well, things can be simple, but be very difficult. I don't think this is particularly difficult, but that's kind of my orientation. As I say, when I came out of college, it never occurred to me to do anything other than save half of my income. But I do recognize that we live in a culture where this is a very alien concept. And so if you've never thought about doing something counter to the broader culture that you were raised in, which is you spend every dime you get because you have to maintain a certain lifestyle, and if you don't happen to make enough money to do that, well, that's what credit's for. You go out and borrow more money. Well, if you've never considered an alternative to that, then this can seem very, very daunting. And if you would have allowed yourself to go down that path for a while, particularly if you've done it with debt and you've created a certain lifestyle, what's known as lifestyle inflation, well, it can be very, very hard to unwind that. The process is simple. You pay off the debt, and then you take that money that you were throwing at the debt to pay it off when the debt's gone, and that's the money you start investing. And of course, you can only do that if you reduce your spending to free up the capital to A, pay off the debt, and then B, invest. So that's very simple. But I'm under no illusion that it's an easy thing to do. And that's, I think, one of the many reasons that there are very few people who will ever pursue the simple path to wealth.
Yeah, it seems to me like the hardest part is the save half your income or whatever percentage that is. Is that a feasible thing, you think, for people of all levels of wealth or levels of income? Or, I think the FIRE community has taken some heat historically for it being driven by, a lot of people with high salaries and no kids a little early, and saving half their income is easy.
That's one of the single things that I get the most pushback on, is this idea of saving 50%. But what's interesting is I get that pushback from two directions. So there are certainly the people that you just described, where they say, this guy's insane. Nobody can save 50% of their money. But at the same token, I have people in the FI community who say, JL, what are you talking about? 50%? That's nothing. I save 60, 70, 80%. If anybody's serious about this, that's where you need to be. But what I really take umbrage at is this idea that the simple path to wealth, or pursuing FI more generally, is only for an elite, high income, maybe techie bro kind of group. That's never been my experience. Ever since I started the blog in 2011, that's the common trope. And in fact, this is my most recent third book, Pathfinders. And one of the reasons I wanted to put this book together is because ever since The Simple Path to Wealth came out in 2016, I've been hearing stories from people who read the book and applied the principles in it successfully. And these stories came from people all over the world and at all kinds of income levels. So it's a matter of how important it is to you.
Is there any similarity across all of the people that you've talked to, especially in the book, on average, how long that journey takes?
I haven't noticed any particular commonality along that, especially not now. In the early years, and again, this was me reflecting what I had done. I'm suggesting 50%, and depending on how the market does for that period of time, that's as I recall, about a 10, 12-year journey. But as I mentioned earlier, there are some people who'd push back and they'd say, I'm saving 60, 70, 80% because I want to get there sooner. But for other people, they're saying, I'll get there with a savings rate of 30, 40%, and it'll take me a little longer, but I'm okay with that.
I talk to a lot of people who love this idea. And even though they might tell you they want the financial independence and the financial freedom more, they're not able to or willing to overcome some of those psychological challenges of cutting back, changing their lifestyle. What do you tell people in that situation?
So I've had a lot of those kinds of conversations. Some of those conversations go, well, yeah, that sounds great, but I got to keep this expensive house I have because, we need to have the 2 leased luxury cars. And of course, kids have to go to the private schools and the list goes on, and that's the tyranny of must-haves. And the more must-haves you have, the less likely you are to be financially independent. It's like anything else you want in your life. And I know that you work with a lot of startups. Well, if somebody says, yeah, I really want to start a business, but, I don't want to give up my nights and weekends, and, I want to go to 2-hour lunches, and, well, good luck with that. That's probably not going to work out. It has to be the most important thing to you. So for me, there was nothing that my money could buy that was more valuable to me than my financial freedom, than my independence. If the most important thing in my life had been living in the largest house I could possibly afford or driving the fanciest cars, well, that's a different set of priorities. And I probably could have accomplished those things, but I wouldn't be financially independent. So it all depends on what you want in your life. And that's one of the reasons, as I said earlier, the vast majority of people are never going to walk down this path. When I talk to people in this community and they're fairly new and they're fired with enthusiasm, and they think, wow, this is incredible. This is so simple to do and the rewards are so enormous. And pretty soon everybody's going to recognize this and everybody's going to be on the financial independence path. And in fact, I've had people say, what's going to happen to the economy when nobody has to work anymore? And my response to that is, well, first of all, we're always going to be unicorns. The vast majority of people are never going to want to do this because it's not going to be a high enough priority for them. One of the reasons it's not is we live in a culture where the overwhelming message is you deserve a break today. If you buy this car, if you dress with this wardrobe, if you, whatever, you deserve to go out to the fanciest possible restaurants and what have you. That's the message that's the constant drumbeat. And my voice and the voice of the entire financial independence community is a teaspoon in the Pacific Ocean compared to that overall. I'm always kind of amazed that anybody says, yeah, that sounds nice, but I still want to drive my fancy car.
Yeah, I think I've come to a similar conclusion that it's just too hard for most people to consider, I guess some of the sacrifices that it would take.
I don't see them as sacrifices. Framing it as sacrifices becomes a roadblock. I think the way to frame it is, it's your money. And presumably you want to spend your money on the things that are most important to you. And only you can make that decision. And I can present to you an option, a different way to spend your money that maybe you hadn't considered before, may or may not be for you, but at least you will know the option exists. It would be terrible to get to be my age and then come across the fact that, oh, I could have spent my money to buy my independence, my freedom. Nobody told me, right? That would be terrible. I don't have a problem with people who hear it and then they say, yeah, I still want to have the boat and the car and the big house. That would be like me saying, why would you sacrifice to buy your big house instead of investments?
Yeah, when you said that, I started thinking, well, I don't feel like I'm sacrificing every time I don't charter a private jet to fly anywhere, which is something I've never done, right? I've never done that. So the fact that I'm not doing it doesn't feel like a sacrifice because I'm choosing not to, well, what would effectively require deplete my entire savings. But I think for people who, in order to shift their priorities to save and invest towards financial independence, need to stop doing things that they're currently doing, might feel like a sacrifice, but in turn, it's really a reprioritization that shouldn't feel bad because you're getting to spend the money where you want. I just think that's hard for a lot of people to kind of come to terms with.
No question. It's kind of like if you've had a terrible diet for all of your life and you decide and you've never exercised and you decide, you know what, I'd really like to have a healthier body. Well, that's not going to be an easy transition, right? That's going to require some adjustments in your life. It's simple, I mean, just like the simple path to wealth. I mean, what you need to do is pretty simple. But yeah, if you've developed a decades of habit doing one thing and then shifting gears is not going to be easy. But the other thing that I think is important to recognize is that if you follow the simple path to wealth, you will in fact become wealthy. And at that point, and probably sooner than you think, at least that's my experience of meeting people at Chautauqua events when I'd have these one-on-one sessions with them, they'd always be kind of a little stunned at how compounding hockey sticks, and they can't quite believe that not only have they gotten there, but how quickly they have gotten there. And to illustrate this, once you're there, you can really afford anything you want. I mean, we fly first class now. I never would have been willing to spend the money because it wasn't worth it to me back when I was building my wealth. But now it's a rounding error. It cost me literally nothing functionally to fly first class. So of course I'm going to do it because it makes my life a little easier. When I was in Ecuador at Chautauqua, Mr. Money Mustache, who has a great blog, if you might want to link to that one too. Pete is his name. So Pete and I were walk into a bodega to buy some wine. As we were walking there, I said, "Hey, Pete, how much does a wine cost in this place?" He said, "Well, it's free." And I said, "Pete, I know things are inexpensive in Ecuador, but it's not going to be free. The shopkeeper's going to expect us to leave some money behind before we walk out of the store with this wine." He said, No. He said, "JL, you misunderstand me." He said, "For you and me, everything's free." And I said, "What the hell are you talking about? I spend money all the time." He said, No. He said, "When you achieve a certain level of wealth and your wealth is generating so much additional wealth that it's generating more than you're spending, everything's free." And that was an epiphany for me because, I'd spent my life optimizing how I spent my money so I could free it up for my investments. And suddenly, I didn't have to think about that at all anymore. So I guess I would say if you really even care about all those fancy things, if you're willing to wait for a little while, then eventually you can have them. And you'll also have your financial freedom.
Yeah, one of my epiphany conversations was with Bill Perkins, who wrote Die with Zero. And what I realized was there's a point at which every extra dollar you either make or don't spend effectively or don't save, like those extra dollars are just going to be left to someone else. And so if you're at a point where you don't even have to be financially independent, but you're on a path to be financially independent at some day, if you save any more money, you just are going to have leftover money. And if your number one goal is to leave some, inheritance to a child or something, great, that's fine. But if that's not your goal, then spending a little more money isn't costing you really anything. And so it was this thing where I just been so focused on saving that the idea that I could save less and spend on something that previously felt lavish, which for me might be like an extra appetizer, right? We're not talking about private jets or anything crazy. It's like, I just wanted that extra appetizer at the restaurant. It felt a little lavish at some point in my life. And then I crossed to a point where saving the extra $5 a year was just going to be a little more money to give to someone when I died. And so I should probably focus on spending it in ways that make me happy and I can enjoy while I'm alive.
Yeah, I mean, as long as you've gotten to that point where your money is generating more money than you're spending, then the appetizer is free.
Or I would argue, even if you're not at that point, but you're still employed and you're on the simple path to wealth, right? You know that future's coming and you get a raise. You could take that raise and you could accelerate how quickly you'll get there, or you could spend a little more and, like you said, kind of coast your way there.
You could, and I think it depends very much on your situation. So, when I would talk to people one-on-one, if somebody came to me and said, I'm really enjoying my job, we'd look at their numbers and based on a safe withdrawal rate, they would be financially independent. And they'd look at me and they'd say, but I don't want to quit my job. And I said, well, being financially independent doesn't require you to quit your job. It means you can do whatever you want to do. So if you're still enjoying your job, then by all means, keep working. On the other hand, if I was talking to somebody and they said something like, I'm in a soul crushing job, and I've done the numbers and I need $50,000 a year to live on, and I got $1 million invested, and using kind of the classic 4% rule, I'm $10,000 short because 4% implies you can pull $40,000 a year out of $1 million portfolio. Well, if you look at the Trinity study, a 5% withdrawal rate survives 30 years. I think it's like 86% of the time. If I'm in a soul-crushing job, and this is what I would say to those people, I'm quitting tomorrow. I want to have to quit yesterday. And I will roll those dice on the safe withdrawal rate. I will watch very carefully to see what the market does. And if I get a bad sequence of return risks, which simply means the market chooses to do very poorly the moment I stop working, well, then I'm going to have to figure out a plan B, maybe find another job, maybe cut back my spending. But I'll also say to people, you didn't get here because you're stupid. You didn't get here because you're incapable of doing competent things of value. Do you think you could figure out something to do on the side that would throw off an extra 10 grand a year to make up the difference? And I've never had anybody say, no, I don't think I could do that. They're like, yeah, no, I think probably pretty easily I could do that, right? So I kind of agree, but it depends on the situation that you're in.
Yes.
And I think it can be a slippery slope when you start thinking that way. It's kind of like, I suppose, a diet. And I have problems with weight, so I speak from experience on this. About 3.5 years ago, I gave up sweets entirely because I couldn't eat them in moderation. And I had given up sweets many times in the past, and I'd give them up for 6-8 months or something. I'd say, this is going all right. I guess I can have that Snicker bar. Well, for me, that's a very, very slippery slope. For somebody who's used to spending a lot of money, I would be very cautious about saying that once you're on the path, you can lighten up.
Okay, so I want to move a little bit from the kind of middle part of this simple path to the investing side, because I think that you have some strong and somewhat controversial opinions. I'll start with the kind of easy of, focused on low cost index funds, but I know you also advocate in many cases for just a one simple fund portfolio. So how do you think about the investing side of saving for people's future?
I sort of break your investing life into two segments. It used to be that, you got out of school and you got a job, and that was your wealth building, hopefully, years. And after 40, 50 years on the job, you retired. And that would be your wealth preservation stage when you're living on the portfolio. Well, these days, I know a lot of younger people who, achieve financial independence or get close to it. They'll step away from their corporate job for a while, and maybe they'll start a side hustle or explore a side hustle further that they were already doing, and suddenly that's making a lot of money. So what I say to people is, when you have income, when you're building your wealth, you want to be invested in 100% stocks. And specifically, you want to be in a broad-based, low-cost index fund. That means a total stock market index fund or an S&P 500 index fund. Either one works. I prefer a total stock market fund because it gives you a little bit of a small cap and mid cap. The same reason I like Tabasco in my food, right? It's just a slight little bit of extra kick. But you can have a nutritious meal without the Tabasco. So the S&P 500 fund is just fine. And that's all you need. And sometimes people say, well, how can one fund give you the diversification you need? Well, if you're in an S&P 500 fund, you're invested in 500 different companies. So every person from the CEO to the factory floor in the 500 largest companies in the biggest economy in the world is working to make you richer. If you're in a total stock market index fund like VTSAX, which is my personal choice, you're in every publicly traded company in the United States of America. I kind of like that. I'm an old guy. When I started investing, you didn't have, in fact, Bogle brought out the very first index fund in 1975. I think he started selling it in 1976. 75 was the first year I bought stock. But in those days, when they talked about diversification, which was a big deal, they would say, you want to pick 6 to 8 industries, and you want to pick 1 or 2 companies in each of those industries. So you have a portfolio of somewhere between 12 and 16 companies, which is all you can reasonably expect to follow well. And that gives you great diversification. Well, with one fund, I have 4,000 companies, I think is what's in VTSAX these days, or 500. That's pretty broad diversification. Now, when you're working and you're putting money on a regular basis into your investments, because remember, we've got a high savings rate, you don't care what the market does, whether it goes up or down. In fact, when it goes down, that's a gift, because now your monthly or your biweekly or whatever it is investment is buying more shares for those same dollars. So those downturns work in your favor at that point. But when you stop working or you stop having that cash flow from earned income, well, now you want something else to smooth the ride that cash flow had done for you, and that's the role bonds play. So at that point, I suggest adding bonds, because now if the market drops and you adjust your allocation, you're taking advantage of that drop, right? If that makes sense. And so I will say to somebody, if you're, say, 30 and you're stepping away from paid work, well, you might want to shift some money over to bonds. And then maybe you're 35 and your side hustles turned out well, or maybe somebody from your corporate career has recruited you to come back to work, whatever. You go back to having earned income, then now you don't need those bonds anymore.
Yeah, it makes sense. Is there also an argument if you're stepping away from work for a year or two to take a year or two of cash out of your portfolio when the market's not down and leave the rest fully invested in stocks?
Sure, if you know you're going to do that, yeah, absolutely. You can, if you know you're going to take a sabbatical for a year or 2 or 6 months or whatever it is, and you want to plan for that. I'm somewhat of an aggressive investor, so if it were me and I was taking 2 years, I don't know that I would have a full 2 years of income, because the market goes up 75% of the time, 3 out of 4 years, and not on a regular path, to be clear. But your odds are much better that the market's going to do okay while you're taking your 2 years off. And I'd probably roll those dice, because money sitting in cash isn't working as hard as money invested in the market can work. And I like my money working as hard as possible. But that's me. If somebody said, yeah, I'm a little more conservative, I'm going to take 2 years, I want to have those 2 years in cash paid for, but you'll get no pushback from me.
Yeah. And it might depend on, what years those are. Right now, you could earn more on your cash today than you could 5 years ago. And, the difference between cash earning 5% and 0% is pretty meaningful compared to an average market return of 7, 8, 9, 10%. But like you said, that's the average return of the market. There are weeks, like I think actually last week was the best week, in the markets in one single week. And so you'd really hate to miss that week.
Yeah, well, of course, there's research that's indicated, I forget exactly what it is, but, it's important to stay fully invested all the time, because if you miss the handful of best performing days, your returns are far lower than the market averages, what the market averages give you.
Yeah, I've seen that study. I'll link to that study in the show notes, because I don't remember the numbers off the top of my head either.
Yeah, by the way, when I was writing The Simple Path to Wealth in like 2013, 14, 15, and at the point of 2015, when I was finishing the manuscript and doing all the final numbers, well, that was a nice 40-year chunk of time from when I'd started investing in 75, right? And so I thought, well, I'm gonna look up what the market actually returned for those 40 years. And when I did that, and I looked at the S&P 500, because total stock market funds didn't exist going back 40 years, I was stunned to see that the market had returned just under 12%. Now, there was no way I wanted to put my book out suggesting to people that they could reliably expect 12% a year over time. But that was the reality of what that 40-year period had done. I actually have a blog post about this called A Time Machine and the Future Value of Stocks, which is one of my favorite posts on my blog. But anyway, I wrestled with this, because, I was thinking, well, 8%, kind of what you just said, is a much more reasonable number. So do I ignore the reality and go with a reasonable number, or do I go with the reality, which is kind of out there? So I went with the 12%. I in big bold letters twice early in the book, I say you can't count on this continuing, because I think, if you're thinking about projections, 8% is a lot safer. Well, of course, in the almost 8 years now since, the markets continued to do extraordinarily well. And by the way, back in those days, people were commonly saying, including Jack Bogle, who's a personal hero of mine, the founder of Vanguard, was even saying the market has done so well, investors have to expect the next decade is going to give much more meager returns. Well, it's been a great decade. So, that tells you that if even Jack Bogle gets it wrong, that's just how difficult it is to predict what the market is going to do. But the market is an extraordinary wealth building tool.
Yeah, I think one of the funny things is we often couch the return rate down. We often, you mentioned earlier the Trinity study, right? It's almost aiming for very, very low failure rate at the expense of you're probably, 90% plus percent of the time going to have, a much better outcome. So if you look at all of these things, we almost optimize our financial future for near certainty with lower than what we've seen market returns, which is almost always going to end us up in a better situation than we planned. And then if you combine that with almost everyone I've seen who has kind of found financial freedom and stopped working has found some way to earn income in their retirement, I would go as far as to say the average person could probably, that's pursuing this path could probably kind of jump into it 5-10 years earlier than they think. Now, that might be aggressive if you're trying to hit it by 30. I'm not saying you could do it at 20, but maybe you could shave 20-30% of the, time off and know that if you're in the 10% of worst cases or the market doesn't perform as it has, well, yeah, you might have to go back, but more often than not, at least using historical data, you're going to be fine.
Right. And the cool thing about the Trinity study is it looked at all kinds of different withdrawal rates. So as I said, you can look at a 5% withdrawal rate, and I'm doing this from memory, so I might not have it exactly, but as I recall, that had a success rate of 86%. Success being defined, by the way, of the money lasting at least 30 years, right? 4%, which has become the 4% rule. I hate the word rule. 4% is a wonderful guideline. It's a terrible rule. But anyway, 4% in the Trinity study succeeded 96% of the time. And somebody, I don't even think it was the authors of the Trinity study, were 3 professors out of a Texas university. But somebody looked at that and said, if you withdraw 4% a year, you adjust it every year for inflation, which is expecting a lot of your portfolio, by the way, it'll last for 30 years, 96% of the time. And that's kind of amazing. And there you got the 4% rule. Well, I think that's a great guideline. You would be insane to start withdrawing 4%, set it on autopilot, and never look at it again. For 2 reasons. If you get a bad sequence of return risk, you could be in that small percentage where it fails and leaves you broke, and nobody wants that. But the more important reason, the more common reason, the more likely outcome is what you alluded to, is that most of the time, if you only withdraw 4%, at the end of 30 years, your $1 million will now be $15 million, right? And that's wonderful, but that also means you will have lost the opportunity to enjoy an awful lot of money along that journey. You could have taken out a lot more. So I say, by all means, use 4% as a guideline. It's a good metric as to how close to financial independence you are. It's not a bad place to start when you're withdrawing, but pay attention. In the unlikely event that the market goes against you, you don't want to wind up broke. But in the even more likely event that your portfolio starts growing, you want to be able to enjoy that.
Totally agree. What do you say to people that kind of critique the US only exposure in your portfolio and kind of say, well, you don't have international stocks and you don't have real estate or you don't have emerging markets?
So my thinking on that is, if you're in the United States, you live in the most dynamic economy in the world, the best possible place to be an investor. And if you're investing in the S&P 500 or the total stock market index, by definition, those largest companies are international businesses. So you have international exposure, but you have it at the least possible cost in terms of expense ratios on your fund, if you're in these low-cost index funds, and you have it in the country that has the best regulations around investments. So your investments are as clear as they can be, whereas in some international markets, they're a little more opaque. So for that reason, I don't see the need to be in international funds. And people will say to me, well, yeah, but if you're not, you're going to miss out on great companies like Toyota and Nokia and Nestle or whatever. And well, yeah, that's true. But I own 500 of the largest companies in the US, or the 4,000 or 3,800 publicly traded companies in the United States, I think that's enough diversification for me. Now, I'm a little bit of a hypocrite because when I talk to international audiences, I say something different. Because if you live in any country other than the United States, and this is a little bit psychological on my part, I think, I would not be comfortable investing 100% in a different country than my own. And so for those people, I say, I would be in a world fund. There is no other country in the world, in my opinion, where you could get away with investing just in your own country, like we in the US can. So for those people, I recommend a world fund. And I also tell my daughter, you're going to want to keep an eye on things because at some point, a world fund will make sense for people in the US as well. The way I think about that is if you go back to the end of World War II, the entire world was in ashes, with the exception of the United States, because the war was not fought on our soil. So all of our factories, all of our cities, all of it was still intact. And that meant that at the end of World War II, the world economy was pretty much the United States, close to 100% of it. We initiated the Marshall Plan to rebuild Europe. We put in a lot of effort to rebuild Japan, which was a good thing for us to do, but it was a very astute thing for us to do because a robust world market is good for us. And as those countries got back on their feet, the pie that represents the world economy that had been 90 some odd % US, well, that percentage of the US began to drop, but the pie itself began to get bigger and bigger. And so right now, the United States accounts for about 60% of all the publicly traded companies in the world. That's different than the economies, by the way. So China, for instance, is a very large economy with a very small number of publicly traded companies. But in terms of what we can do as investors, it's about 60%. Well, that pie will continue to get smaller and smaller as the rest of the world continues to prosper. That's a good thing for the United States because as the rest of the world prospers, that builds our prosperity because our companies are international companies. But at some point, our slice of the pie will get to be small enough that maybe it doesn't make sense to just be in that one country anymore. I don't think that's going to happen anytime soon. I don't think it's going to happen in my lifetime, but it is something that I tell my 32-year-old daughter to pay attention to because at some point in her lifetime it might.
Does this change depending on how much money you have?
I mean, exotic investments are created to make money for the people who sell them. I look at hedge funds as an example, and I'm amazed that anybody buys hedge funds because a hedge fund, they're going to charge you 2% right off the top, right? As a management fee. That's huge. VTSAX charges me 0.04%. So that's huge. But then if they make money, not if they outperform a benchmark, if they make money, they'll take 20% of those profits. Now you know why hedge fund managers are billionaires. It's not necessarily that they're great investors. They don't make their money on investments. They make their money on persuading people to put their investable money with them, and then they charge 2 and 20, as it's called, 2 and 20%. Well, as I mentioned earlier, the market goes up 3 out of 4 years. So every fourth year, they're only going to make their 2%. 3 out of those 4 years, even if they put in a very mediocre performance, they're going to take 20% of the profits. How does the investor make any money? How does that's why the investors are not billionaires, right? So I don't quite understand that. Now I do, if you want to get a little more sophisticated about hedge funds try to mitigate risk and for pensions. And so they would argue, well, we're not going for the maximum market return. Warren Buffett famously did a 10-year bet with a friend of his who ran hedge funds. And the bet was, Warren said, I'm going to choose the S&P 500 index fund, and you go out and pick whatever index or whatever hedge funds you want, some collection of them, and, we'll invest for the next 10 years. And the first couple of years, it was looking bad, frankly, for the index fund, because in some markets, hedge funds will do better, specifically, I think, in down markets. But we don't have that many down markets. And about 2 or 3 years in, the index fund started to take the lead and never looked back and just absolutely crushed the hedge funds. Now, the hedge fund guys would say, well, it's not total performance that matters. We deliver other kind. Fine. If you can convince your investors of that, that's fine. I want my money to make me money. And I don't care about the volatility because I'm just going to keep investing through it. I'm going to take advantage of the fact that periodically the market drops, which is, by the way, is a perfectly normal part of the process. It is nothing to be upset about or concerned about. Corrections and bear markets and crashes are to be expected. They have always happened and they will happen in the future. If anything, they're a great opportunity because now your money goes further when you're investing it. You just have to not panic. The only way you lose is if you panic and sell. And then of course, as Warren Buffett once said, you lose when you try to dance in and out of the market. But if you stay the course and you just keep investing, as I said earlier, those drops are your friend. If somebody young is listening to us in particular, who's just starting their investment journey, the very best thing that could happen for that person is a major market crash that just drops all the prices down, because this is when you're buying. You want to buy things at a low price, right? And then ideally, the market skyrockets when you're ready to withdraw it. Of course, the market's not going to do that for you.
Yeah. We never know what it's going to do. But I do think that the hardest thing is just ignoring it when it's happening. And I have weeks where I haven't checked on the market at all, and it kind of feels good. It kind of feels irresponsible to not know what's happening, but it feels good to not be checking my portfolio.
The reason that it feels hard is because, again, if you listen to the broader media, it's amazing to me. The market will drop 2%, and you would think the world is ended listening to the financial media. So, of course, people are nervous. Jack Bogle once said, and this is back in the days when we got paper statements, so before everything came to us electronically, he said, what you should do is invest in the S&P 500. Don't even open your statements. I think they send them quarterly. Don't even open the statements. Don't even look at it quarterly. Just throw them away, and at the end of 20 years, open that statement and have a cardiologist standing by, because you will be stunned at how much money you have earned. But if you're always looking at it, it's always going to make you nervous. I look at it all the time, by the way, because that's sort of my wheelhouse. But I've long since, I'm long since taken the antidote to being nervous about the drops. I kind of get greedy when it drops. I think, maybe I can move some of those bonds.
That's a good time to buy. You've talked a lot about VTSAX. I want to make a little distinction for people listening. When you say VTSAX, VTI, the ETF, very comparable, if not identical, alternative for people who aren't investing somewhere where they have access to a Vanguard mutual fund. Is that fair?
That's exactly right. VTSAX is Vanguard's total stock market index fund, Admiral shares. VTI is the ETF, exchange traded fund version of that. ETFs are they're a little different kind of an animal. I invest in the fund because I'm an old guy and that's what I started with. But if you're in VTI, you own exactly the same portfolio. And the other thing I will say is, as big a fan of Vanguard as I am, and I am, a broad-based index fund, an S&P 500 fund, or a total stock market index fund from Fidelity or Schwab, it's essentially the same portfolio. Sometimes they follow a little different index, but the differences are so small that it won't make any difference. So if you happen to be at Schwab or Fidelity or whatever, and you're in their total stock market index fund or their S&P, you're fine. You're golden. That's great. Or their ETF versions as well.
Yeah. And if the market crashes heavily and, your portfolio is down, personally, I've been known to switch between them to kind of capture some of those losses. So, if I look at my portfolio, I can't remember all the names of all of them, but I think ITOT is another index fund alternative to VTI. And so if you had invested all of your money right before, the pandemic and you saw your portfolio down 30%, I will say, don't sell with the big asterisks unless after you sell, you're buying something with a very similar but not identical track record, right? If you want to swap your S&P for another large cap US index fund with a similar, exposure that isn't tracking the exact same thing, you could capture those losses and it could have some tax impact. I'm not a CPA here, but it's something I've done and been able to use.
You're right. So just to elaborate on that a little bit, if the market, let's say you're in VTSAX as I am, and the market crashes, and now you have some losses that are useful to have for tax purposes, and you can carry them forward. So any loss you have in a given tax year, you can use to offset any gains you have in that tax year, plus $3,000 of ordinary income. And if you can't use all those losses in a given year, you can just carry them forward indefinitely. So your strategy is a good one. You're kind of banking those losses for future reference. What I do is I would just go from VTSAX to the S&P 500. That's different enough that the IRS will accept it. You have to hold it for, Vanguard won't let you switch back. And I think for tax reasons, you have to be out of it for at least a month, at least 30 days. But then because I like I just go back in. But I am always, the point is that, and you were making this point, I'm always fully invested. What you don't want to do is say, oh, the market's down, I'm going to sell my stock fund and sit in cash until things get better.
I would not advise capturing those losses by being out of the market for 30 days. But if you wanted to swap between different, large market index funds or the S&P and total stock market, that would be one tactic. I am curious if you've considered any of the direct indexing kind of services or tools that basically allow you to buy the total market or the S&P, but at an individual stock level instead of an index fund, so that you can do that similar tax loss harvesting at a company level.
Yeah, but why would I bother? That, remember I wrote The Simple Path to Wealth. That just sounds a whole lot more complex. I can just switch from the total stock market to the S&P 500 and back again, and job done.
You did mention that, one of the great things about VTSAX, and I think VTI also, is a really low expense ratio of 0.04%. I'm sure I'll say this and you would agree. As you're looking at some of these funds, I think the most important thing is to keep an eye out for fees, because I have found that in some, brokerage accounts, in some retirement accounts, you might see a fund that says it tracks the S&P or tracks large cap US funds and has a much, much higher expense ratio. So when it comes to low fees, I don't know if you have a threshold, but I'm always targeting something very, very low and keeping a close eye on it, especially with retirement accounts where you don't get to pick from any fund that is out there.
Yeah, so fees are incredibly important. I mean, we touched on that a little bit when I was ragging on hedge funds, right? I mean, fees are a ball and chain on your returns, and there are people who have done posts and great work showing how what seems to be a almost insignificant 1% annual ER expense ratio, how big a drag over time that actually is. I mean, it amounts to huge amounts of money. So fees are incredibly important. But on the other hand, I mean, I think Fidelity offers an index funds S&P 500 total stock market index fund with no fee at all. But by the time you're down to 0.04%, I'm not going to worry about that. I'm not going to go rushing over to Fidelity in order to avoid that little bit of a fee. And then you're right, when you go to 401k programs, and I think they've gotten better. Initially, they were horrible. I mean, the kinds of choices I'd see in plans that people would bring me, there was no index option at all. Now I tell people, and frequently these plans have scores of funds to choose from, which, again, in my world is kind of nonsensical. But typically you'll have, if you have 401k, you will be able to get a list of all the funds they have. And there should be a column on that list of the expense ratios, the ER. And what I tell people, especially who are not familiar with the different funds, the way you find the index funds is you put your finger on that column and you start scrolling down looking for the lowest number. And when you start seeing things that are like 0.05, 0.04, you found the index funds. And then look at those and you should be able to figure out, oh, that's an S&P 500 fund, or that's a total stock market, and that's what you want.
Yes, and if you can't find anything that you like, I've said this before, unless it's your current employer, you can take an old 401k and you can roll it into your existing employer's 401k. You can roll it into a rollover IRA. So I have had some employers where the 401k options were just pretty terrible. But unless you work for that company currently, you don't need to keep the funds in that employer's 401k, especially if they have bad investment options.
Point well taken. I have always, in my corporate career, if I left a job, I always rolled my 401k into my IRA. It just gave me more control. I don't quite understand why anybody would keep a 401k at a company they didn't work for anymore.
I'll make one case. If you take advantage of trying to do a backdoor Roth contribution, having pre-tax money in an IRA can make that tax-wise complicated. And so I have tried to make sure I always roll my 401ks into other 401ks with good fees so that I'm not putting them into IRAs, because I like to do that backdoor Roth contribution every year.
That's a point well taken. And I think there's also some advantage to a 401k in terms of liability. It's not as for bankruptcy or maybe lawsuits and things, it's a little more protected than an IRA or something. So there are a couple of reasons that you might want to stay in a 401k.
But I would rather give up the Roth contribution, backdoor Roth ability, than if I were stuck in an employer paying 1% fees on all my retirement assets. I'd rather give up my backdoor Roth and be able to cut my fees. So if someone is looking at a situation where they don't have a good 401k to go into, I wouldn't think about it at all. But or I would slowly try to roll over my pre-tax to after-tax if I were at a low enough income.
That's a great point and a great illustration of just how important fees are. The fact that you make that assertion, that should demonstrate to anybody listening who might be saying, well, how bad could fees really be at 1%? Well, that's a good indication of how bad they are. The other thing, by the way, while we're doing a little bit of clarification that I should mention is that when you say index fund, you have to be a little bit careful because there are index funds for almost anything now. So there are a lot of sector index funds. You can get an index fund that buys gold shares. You can get an index fund that buys technology or consumer goods or energy. That's not what I'm talking about. I'm talking about broad-based, low-cost S&P 500 total stock market index funds or the total bond market index fund. So, and that's a tiny sliver of what So if somebody says, oh, buy this index fund, it might not be the kind of index fund that you and I are talking about today.
That makes sense. And to the point of the simple path to wealth, just the idea of having a brokerage account with just one fund, in every single, whether you have a 401k, an IRA, and a pre-tax, there is something nice to the simplicity of it. Even if you feel like you might want more diversification, I would argue that there is some value, and I'm not going to try to predict how much it is for any individual, but there is some value to just not having any overhead on, tax-aware allocation and what you buy and rebalancing and all of that. So,
yeah, there's great value. I hold VTSAX in 5 different accounts, or my wife and I together. So I have a Roth and I have a traditional IRA. They're both in VTSAX. My wife has a Roth, a traditional IRA. They're both in VTSAX. So that's 4. And then we have a joint account, and the stock portfolio in there is VTSAX. So I hold it in several different buckets.
I left the last pillar of the simple path to wealth for last because I feel like it might be the least controversial, but I feel like it's worth at least spending a minute on debt. You said avoid it at all costs or pay it down. I guess, is that all debt? Is that only high interest debt? Where do things like mortgages fit in?
So to me, the fact that in our culture, people commonly carry debt, and it's encouraged and they're comfortable with it. It's like being covered with leeches, and it has the same effect. They're sucking the blood out of you. And I tell people, take out your sharpest knife and start scraping little suckers away. Are there any exceptions to that? Well, you mentioned mortgages, and for the vast majority of people, and this includes me when I was younger, if you're going to own a house, which I think you need to be very cautious about making that decision. You certainly don't want to buy the most house the bank will lend you money for. You want to buy the least house that meets your needs, the least expensive house. But anyway, you're probably going to need a mortgage, and that's okay. And then depending on your mortgage rate, what interest rate you have, if you get in a position of being able to pay it off, you may or may not choose to do that. If your rate is low enough, you may be better off keeping the money invested than paying off that mortgage. The other exception would be if you're in business in some fashion, whether it's investment or real estate, you're probably going to be carrying debt. If you're starting a business and you're a startup guy, you might wind up taking on some debt for that business. Again, that's okay, but anytime you take on debt for any reason, you should do it very reluctantly, very carefully, with your eyes wide open. So at this point in my life, I don't have any debt at all, and I have never carried any debt other than the mortgage when I had one.
Yeah, I think I follow a similar plan, other than if you have a plan to pay off your debt and the interest rate is low enough, then I don't personally have a problem with it, right? I have a 5-year on a car that was at 1.99%. I feel really good keeping that and not paying it off. But I have a plan to pay it off. And, for me, that's okay. But if I had any debt that was probably over 5% for me, I would be aggressively trying to pay it off myself.
I would agree with all those things. If you have, especially in today's interest rate environment, I mean, if you have any kind of debt that's, under 3%, under 4%, that's kind of golden, actually. So I wouldn't be in any hurry to pay those things off, whether it's a student loan or a car or a mortgage. But I would avoid accumulating the debt to the best extent possible.
So I think you'll use the same pushback here as you did on direct indexing, but I will try for one more. Let's assume we were at a slightly lower rate environment like we were 5 years ago. You mentioned you had a mortgage, low rate. It's okay. We talked about the long-term returns of the S&P 500. Would you ever make a case for levering up your S&P or your VTI or your VTSAX exposure if interest rates were low enough?
So that's how we wound up with the Great Depression. Okay. So the simple answer to your question is no, I would never do that. I would never leverage stocks. In the 1920s, which of course were a very robust time for the stock market up until the crash, people started embracing that idea because they saw the market was consistently going up. It dropped down a little bit and then it can consistently go up. And people started saying, wow, if it's going up 20% a year, imagine if I leveraged it, now I'm making 40%. And a lot of people started doing that. And the problem with leverage is that when it's a two-edged sword, when things are going up, it absolutely enhances your returns. But if it goes against you, that's how you wind up broke. So the stocks went down in the Great Depression 90%, right? So if you followed the simple path to wealth and stayed the course, let's say you had $1 million and your portfolio went down 90%, now you've got $100,000 and that's going to be a very bad day, but you're not broke. And oh, by the way, the Great Depression was, as anything like that is going to be, deflationary. So now your $100,000 actually has more buying power than it did before the market crashed. So it's not quite as brutal it's still brutal, but it's not quite as brutal, but you're not broke. If you had taken on leverage, the moment the market, let's say 50%, the moment the market's gone down 50% and you're called, you're broke. You're forced to sell everything. And now you're out of the game. And that's what happened to so many people. That's how great fortunes were lost, is they got margin calls. They had to sell their holdings to meet those calls. And sometimes it went down so quickly they couldn't even do that. And that's how you wind up broke. If you don't leverage, unless it goes to zero, and even in the Great Depression didn't do that, you're going to be okay.
Okay, before we wrap, I want to loop back a little bit to where we started. And I've heard you often say financial independence is more about freedom than it is just about wealth. But the book is The Simple Path to Wealth. So which is it?
I think it's both. I mean, to have financial freedom, you need to have a certain level of wealth. I mean, by definition. But the point is not to accumulate the most amount of money that you possibly can. The point is to have enough to cover all of your expenses and a little bit more, and if you accumulate a little more wealth than that, then you can expand your spending. It depends on what you want. There are people out there, and I know some people like that, who have no wealth at all, but they are comfortable living at such a modest level that they are financially independent by definition.
And what would you say to the person that hears all of this, but is still stuck in that mindset of trying to build more?
Yeah, there was a guy at a stock a couple of years ago who fit exactly that profile. He was a very successful dentist, but very successful in his practice, and he was expanding his practices. I did a one-on-one session with him, and he was talking about the new business that he was going to build or buy, I forget. And I said, you don't need to do that. I mean, you're where you have more than enough to not work at all, let alone continuing to expand your business. And he was complaining too about, it took so much time from his family and, it was such a big commitment. And I said, stop, don't do it. I mean, you're wasting your life. By the way, he didn't follow my advice. He probably went back and continued to do it. There was another woman, she was a banker. And on the following Monday, she was going to go take a new job that was going to pay her $1 million a year. So obviously a very successful banker. Her question to me was, am I financially independent? We're looking at her numbers. She had $5 million in assets. I said, okay, that's only one metric. The next thing we have to know is how much you're spending, right? And so she said, well, I spend $100,000 a year. Well, $2.5 million throws off at 4% throws off $100,000. So I said to her, you are not only are you financially independent, you're that twice over based on your spending rate. If you're taking this job because you think you need the money, think again. When she took the job, but I think for better reasons than the dentist, because I think she really wanted to do it just because that's what kept her energized and engaged. And that's, like I say, just because you're financially independent doesn't mean you have to quit your job. But at the same time, if you're in a soul-crushing job, then you might want to stretch the parameters of what financial independence means beyond that 4%.
What I heard was that for both of them, one of the things that might help someone is just taking the time to understand where they're at. If you've never looked at your net worth and you've never looked at your spending and calibrated how close you are to some version of financial independence, then it might feel like you need more money than you do. But I've had a few friends where I've kind of played the role you did, and they were closer than they thought. And so they didn't need to go take that grinding job that was going to pay them more money and take them away from their family as much as they thought, because I don't think they'd never even done the math or run the numbers.
One of the striking things in doing these one-on-one sessions at all these Chautauquas was very frequently, of course, people would want me to look at their numbers. And the question would be, am I financially independent? Again, these are very bright people, and the formula is very simple math, right? And so you say, well, why would they even need to ask that question? And it got to the point where the question was so common that it was a little bit baffling to me. And the more I thought about it, the conclusion I came to is that compounding, which is the process of something growing exponentially, whether it's debt, by the way, which of course grows against you, or your investments, compounding is something that we didn't evolve as human beings to really understand, because in that natural world where we evolved, there isn't such a thing. And what happens if you look at a graph, a compounding graph, it's a hockey stick, right? There's this very, very slow, gradual increase that's almost imperceptible. And then all of a sudden, you get over the right-hand side of the graph and it spikes up. And I think that's why people would come to, because they can see the numbers, they can do the math. They just can't believe what they're looking at, because it seems like it takes forever, and then suddenly it happens. And that's also one of the reasons that everything's free, is because suddenly your portfolio is throwing off so much money that, when the market moves up or down, it's a rounding error for you. Now with my investments, the market, if the market drops or rises for that matter, just a little bit, it can be more money than I ever made in my corporate career in a given year. But that's hard to wrap your head around when you're on the way to getting there, that's where you will wind up.
Okay. So my last question, what do you think the real benefit someone gets from achieving financial freedom and independence is?
Well, if you really understand this, you'll understand that the answer is actually embedded in your question. And the answer is freedom. The most important thing my money could ever buy for me is freedom. Freedom to spend my time the way I want to spend it. Freedom to work for whomever I choose. Freedom to step away from any job I choose. Freedom to live my life on my terms, and however, wherever that takes me. So what is the point of financial freedom, or the best benefit? It's that freedom part. And it's possible for anyone. Anybody who has the technology to be listening to this interview, it's well within their reach.
Then finally, where should I send people who want to go deeper on all these topics?
Well, if you just Google J.L. Collins, a whole bunch of stuff will come up. I say go to the blog, which is jlcollinsnh.com. I'm on Twitter. I'm on Facebook. That's the only social media I bother with. So if you want to follow me on those two places, and not almost everything in The Simple Path to Wealth you can find in the stock series. So you don't even have to buy the book. Now, the book is more concise and it's better organized. but you can get that from the library for that matter. But yeah, I'd start with the blog.
Yeah, I think the book's a great gift, though.
I'm all for people giving it as gifts. But I think actually, if you want to introduce somebody to the concept, Pathfinders is 100 stories of people who read The Simple Path to Wealth from all over the world, all different backgrounds, all different kinds of challenges, and they've taken those principles and made it work for them. And I think that those kinds of stories, if we're trying to persuade people, are probably the first step. And if you give people Pathfinders and it resonates, and then they want to know, okay, well, how do I do that? Then go pick up The Simple Path to Wealth.
I like it. I like it a lot. And I would say that it's a spectrum. I've introduced a handful of people to the concept of financial independence who have not necessarily taken it and done everything, but it's had an impact on their life. So I hope this conversation has an impact on everyone listening's life, and feel free to share it with others. And JL, thank you for staying with me so long and joining me today.
Thank you, Chris, so much for the invitation. It's been my honor. And like you, I hope that everybody who listens to this at least checks out the concept. And if you understand that this is something you can do with your money and that it can make your life vastly more free and successful, then that we've accomplished the goal. If you choose not to do it, if you want to spend your money in different ways, well, it's your money. But at least now you know that the option exists.